For the last 3 decades, Knowledge Center at Bursa has offered technology, resources, services, space, and a sense of community. Since 1985, 14,000 titles have been collected, with care and attention to high financial literacy standards. In collaboration with a global community of institutions, we ensure access to the world's diverse intellectual and cultural economic heritage, as well as fast online services for connectivity to the financial world. Serving the Bursa Malaysia community and beyond, Knowledge Center at Bursa empowers you in your trading and investment analysis research.
Financial information at my fingertips.
Visit Knowledge Center at Bursa Malaysia today for the collections, for the services, for the sense of community.
You have suffered financial loss while investing, and you think your bank, broker, fund management company, unit trust management company, PRS provider or distributor, or their agent or representative is responsible. You need help sorting out the problem or want to seek redress. Where do you go? Sidrek is here to help you start the conversation and reach some resolution. First, lodge a formal complaint with a company that sold or offered you the unit trusts, shares, derivatives, or other capital market product or service. But you're not happy with their response. You have 180 days from their final written reply to come to Sidrek. Or if there's no written response, and it's been 90 days since you wrote to them, you don't need to wait longer. You may come to Sidrek even though you haven't received a final response yet. Sidrek first checks the eligibility of your claim. For example, is it within Sidrek's claim limit? Is it against a member of Sidrek? And so forth. If your case is eligible, we begin the dispute resolution process. All information in this process is confidential. We get both you and the member you're complaining against to sit with us and have a conversation. Documents and information will be required from both parties. No lawyers are allowed in the mediation process, as we keep the discussions informal and private. Our mediators are impartial and will hear both sides out and help parties communicate constructively towards resolving the dispute. 2 outcomes are possible at this stage. Either both you and the member agree to a settlement, or you don't. If the both of you agree to a settlement, an agreement is signed and the mediation process ends successfully. But if both you and the member fail to reach a satisfactory resolution, mediation has thus failed. But don't worry, Sidrek then proceeds to the next stage, adjudication. During adjudication, parties are given the chance to provide any further information to help their case and ask each other further questions. Our adjudicator will then study and consider all facts and information provided, including the conduct of the parties, laws, and best industry practices, as well as what's fair and reasonable. Sidrek's adjudicator will then make a final decision on the dispute and the monetary claim. If the decision is in your favor, it could be a full award or a partial award for your claim. But if the decision isn't in your favor, then no award will be made. You, the investor, will still have a choice. If you reject the decision, Sidrek will simply close the case and you may seek other legal avenues for redress. If you choose to accept the decision, however, the member has to comply with it. Once the parties have confirmed compliance to the decision, Sidrek will close the case. So let Sidrek help start the conversation towards resolution. For more information, visit sidrek.com.my or call 03 2282 2280.
Bursa Malaysia has been part of the Malaysian economic growth for over 4 decades. we have been working relentlessly to create a transparent, efficient, and vibrant stock exchange.
While we've been working at building a vibrant marketplace, inclusivity and contributing towards economic growth, we have also channeled efforts and resources towards supporting the community at large. Shares to Share is one such effort, which has been developed to create positive impact towards society and the environment. To put it simply, Shares to Share is a transparent and easily accessible facility that enables investors to donate their listed securities or proceeds from the sale of their listed securities towards charity through Yayasan Bursa Malaysia. You can donate odd lots or even board lots. The funds from the sale of these shares will be channeled to approved charitable organisations and their respective initiatives or projects.
Bursa Malaysia has waived its portion of the transfer fee, clearing and trading fees for all transactions that are conducted under Shares to Share. The participating brokers of Shares to Share have also agreed to waive their portion of the transfer fee and brokerage. The charitable organizations that have been selected have undergone the necessary due diligence process and have been duly approved by an independent selection committee.
At least 500,000 populations live with some kind of disabilities. They are most of the time being left behind. We need to empower them, otherwise they will continue to be the liability. A lot of human resources wasted from this group of people.
We provide a lot of support for persons with disability who are young adults and adults. We have a social enterprise called Project I Am Possible, where we managed to hire all persons with learning disability to work here. We have a cafe, bakery, weaving, and we have an art gallery.
Purity of thought, word, and deed, that is action, is very important to be really successful. We must know some skills to be able to help us then paperwork. The grant from Shares to Share will be used for, one is sewing, handicraft, classical dance, and so on.
Our patients have to be fed, they have to be looked after. We look out for any sort of disease they might develop, and also those unforeseen circumstances. Thanks to Bursa's initiative, we can be a little bit easy on our patients and their family members.
Donations will all be channeled to organizations that are involved in the sustainable development of Malaysia. The Shares to Share scheme offers you the chance to do so in a simple and effective way.
Bursa's Shares to Share allows us to do good by donating our shares to charities. Join us in making a difference to the society by donating your listed shares.
Shares to Share is open to all donors, individual as well as corporates or other types of entities. You can transfer your listed securities via Bursa Anywhere app at a click. For more information, please visit our Bursa Malaysia website.
Hello everybody! Welcome to this webinar brought to you by Bursa Malaysia and managed by our company LifeChamp. Today our webinar's title is Grow Your Wealth with Unit Trust. So welcome everybody to this session. My name is Jane Chu. I'm the moderator for this session. Now, I'm sure many of you here have heard about Unit Trust, and today we're going to talk about how do we grow our wealth in Unit Trust and what exactly a Unit Trust and how we can use it to compound and grow our wealth. Before we begin, as usual, disclaimer, whatever we share in this session is only for educational purpose. In no way that I give any recommendation for you to buy or sell any listed securities that we mentioned here. If you decide to make any investment decisions, you're 100% responsible for all your investment risk. Allow me to introduce our speaker today. Our speaker is the financial blogger at Bull Bear Bursa Facebook page. He is also a certified financial planner from Financial Planning Association of Malaysia. He is a former research analyst and premier banking investment consultant. He holds a capital market services representative license for financial planning with expanded scope to advising on equities, debentures, or warrants listed on Bursa Malaysia. He is none other than Mr. Anson Tan. Anson, welcome to this session. How are you today?
I'm totally fine. Very exciting to do my sharing today. Yeah.
Fantastic. So we can't wait to learn from you today. So I will just stop sharing my screen and hand over the control to you.
All right. Thank you, Shane. So good evening, ladies and gentlemen. Thank you for attending the session today. So give me a moment. Let me share my screen.
Sure.
All right, Shane, you can see my screen clearly, right?
That's right. I can see it. Perfect.
Okay, then I guess I will take over from here. Thank you for the introduction. Okay, so basically today, the topic of my session today is how we can actually use unit trust as an investment tool to grow our personal wealth. Okay, so I would say most of the investors, if you use Bursa Malaysia as our exchange, you will be using some of the broker from the market. Okay. So you have your own CDS account and your stock trading account. So basically what you do for your investment is what we consider as an active investment. Okay, so today we will talk more about passive investment, how you actually invest passively through investment tool like unit trust. How does unit trust can actually help public or retail investor like us? What are the fee and charges that we should be looking at? Then how do we actually evaluate the performance and the fund returns? All these are the key things that I will really highlight in the session today, I guess. Okay, so let's jump to the first session. What are unit trusts? Okay, so I believe there are a lot of investment out there. Easily people heard about stocks, equities, investment. So, and some of the other asset class that we can actually get from the market, it could be like fixed income investment like bonds. I also did some other webinars for the bonds and the fixed income with Shane and the LifeChamp previously. So today I will focus more on the unit trust and funds. Okay, so yeah, okay, so in the mind of the retail investors, there are a lot of they basically have this kind of biases or myth, right? Okay, thinking that why do we actually need unit trusts? I would say this is the key myth that a lot of investors will have, because they believe that unit trust is not performing, and most of the unit trusts in the market, most of the funds in the market is not performing, and fund managers, they are just taking charges and management fee from the investor like us, but they are not performing. This is the key issues. That's why most of the investors, they are unhappy with unit trust and they don't want to invest passively via unit trust. Okay, so they would basically think, why not I just do it myself? Pick a good stock and just buy and hold. This is the I would say the key cognitive biases that most retail investors have in their mind. All right. So before we start the whole session, right? Okay, I would like all of the audience here to actually think about your own investment path. Okay, think about whether in your own investment journey or investment path, perhaps you have started investing for the past 3 years since COVID, or more than 3 years, for 5 years or 10 years. Okay, just tell me whether in the past, averagely, can you actually achieve a return that is greater than FD? So if we set a FD performance benchmark of about 4%, okay, so if you have been investing for 10 years, okay, perhaps what kind of return that you actually got from your investment? Okay, you no need to share out what kind of return that you actually get, but if you can actually outperform the FD return of 4%, just key in 1 in the chat box. If you can't, just type 2. Okay, So yeah, let's see what kind of outcome that we can see from the audience today. Okay. So far I see most of you actually put a 1 now. Okay, and yeah, but there's a lot of 2 coming following. Okay, so don't be shy if you are not getting a good return. It's okay, because ultimately there's a lot of factors that is affecting us, influencing the investment returns of our portfolios, I would say. Okay, so I would say there's a mixture of 1 and 2. Okay, so if I increase the threshold from 4%, the FD benchmark return, if I increase it to 8%, how many of you can actually outperform 8% averagely every year? Which means if you invest for the past 10 years, every year on an average basis, you can outperform 8%. If you can do so, give me a yes. If you can't, give me a no. Okay, so far all of the result is a no once I increase the threshold from 4 to 8%. Okay, just share with all of the audience here today statistics that I was a bit shocked when I really talked to most of the remiser in the market, whereby when I ask them how many percent of your clients, right? Because as a remiser, you can actually get access to the investment holdings of your client. You can get to see what's their performance in the past and things like that. Okay, and to my surprise, they actually tell me more than 90% of their clients are actually making losses throughout their whole investing journey. Be it they invest for how many years or so. If you look at the realized P&L, more than 90% of them are actually making losses. 90, 90, okay? So I would say, if we look at direct active investment, what are the key problems that or issues that why normal investors, retail investors, they can't really outperform the market benchmark? If we look at globally, 8% is still underperforming the US Nasdaq average performance. Okay, because in the past 30 years, if you look at standard index, okay, like S&P 500, right, they're actually averaging a yearly average of 9% for the past 30 years. So in fact, if you are not getting anything more than 9%, you are actually underperforming the benchmark already. Okay, so what are the key reasons that a lot of investors, they cannot do it themselves? Because here you can see you need to choose an investment path. It's either you want to do it yourself or you want to let the professional to do it for you. Okay, let the professional to do it for you. It could be wired through unit trust, whereby the fund managers or financial advisor like me, myself, I'm a licensed financial advisor with UOB. Okay, I'm licensed is actually with UOB. Okay, so I'm licensed by ST to actually give investment advice to my clients. Okay, so the key problem that we have with retail investors when they want to do it themselves, the key thing is about they don't have the right necessary knowledge to actually evaluate what should they do in different market condition. This is the key thing I would say. No right education, because in our primary or secondary schools, the studies, there's no financial education that has been conducted by the government to actually to all of the students. So all the financial literacy in the market, we have to actually gain through the other third-party sources kind of education. Then only we can get to improve our financial literacy. This is the key issue. So they don't have the right knowledge is the key problem. Okay, for the DIY active investing investors. Okay, then the next one, it would be when we talk about investment, it's not just so much about whether you know fundamental or whether you know technical analysis. It's not so much about So it's not solely about knowledge. It's not solely about knowledge. It's also about emotion. How you really control all your emotions when market are going against you. Market are performing unfavorable to your direction. Okay, all these things is also another key concern why the key problem, the key obstacles why investors are not performing well in their investing journey. And I can tell you, as a professional, I spend most of my time dealing with client. It's not so much telling them how we are actually looking at the market. I would say more than 70% of the time I will actually need to spend my time to try to modify or fix my clients' emotional bias. Like some of the emotional bias that we can easily name it, it would be a loss aversion bias. So once for example, if you invest into a stock, and you make a 50% losses already, and if you look at the current market juncture and the business of the company, and you know it's pretty hard for you to actually gain back the 50% losses that you are actually having on the paper already. But because of the loss aversion bias, most of the investor would think, if I don't realize, if I don't sell these stocks, I will never make this loss. No, in fact, you already make this loss, although the losses is actually on the paper. Because when we talk about investment value, we look at the market value of the equities, we look at the market value of your investment. Looking at today, what's the market value? If it's down 50%, you need to be realistic that if you want to break even on this investment, right, you need to make sure you get the return more than 100%. This is right? Because if, for example, if your investment is 10,000 ringgit, if you lost 50%, it becomes 5,000. So you need to ask yourself a question whether this company, this stock can actually double up. If this company, the share price cannot double up, actually there's no chance for you to break even on these stocks. So there's a lot of emotional biases that is the key obstacles, I would say, that stopping the investor from making consistent return. And as a financial professional, like a financial advisor, I have spent most of my time trying to fix my client biases on all these areas. So I would say the key key reasons, why investors are not making good returns when they are doing it themselves. The first thing, they don't have the right knowledge. The second one, they have a lot of retail emotional biases whereby they don't know what is the right mindset when you want to do the investment yourself. Okay, these are the key two reasons, of course. Okay, then the third one, it would be experience. And if I want to name the fourth one, it would be some of the investors, they don't really have market sense. This is the key problem. All right. So as investors, we will need to choose our own journey, whether you want to do it yourself, or if you believe that you can't really hit or fulfill all the criteria that I mentioned just now, all right, then it's better for you to let the professional to do it for you. Okay, because they are full-time, they are actually spending most of their time looking at the market, looking at all the news flow, and they know what to do at the best timing. All right. So this is the key thing that I want to highlight before we start. Okay. So let's move forward to the next slide. What are unit trusts, I would say? Okay. So unit trust, on the number, the first number you can see. So as if us standing as investors, right, we will be called as unit holders. So when we put our money into the investment, okay, when we put our money into the fund, to the unit trust fund, there will be a trustee that will be safeguarding our interest, which means they will be segregating the asset from the fund house. Okay, so at this place, it will be a little bit not so clear. Okay, so because most of the time, right, investor were to ask one question. Now I invest my money into a unit trust with, for example, Maybank. Okay, Maybank, be it their fund, Malaysia Sukuk, a Maybank bond fund. Okay, so they invest their money into a Maybank bond fund. So if anything were to happen to Maybank, Maybank goes into bankruptcy, and what will happen to my fund? okay, what will happen to my investment? I will tell you, your fund will stay safe, okay, because there will be a trustee, they will be safeguarding your interest and your money, and your asset will not directly park with Maybank. It will actually park at the trustee side, whereby if Maybank want to invest into some asset classes, if they want to invest into something, then they will send the instruction. They will send the instruction to the trustee and let them know, hey, for example, the trustee could be mBank, okay? So we tell mBank trustee, whereby we need to buy this stock, we need to buy this bond, so please execute for us. So the trustee will actually transfer the money over. So this is how the unit trust fund works, whereby there will be three parties: the unit holders, the trustee, and the fund manager. The fund manager, they are the one that doing the investment and giving the directive, the investment direction to the fund, okay? So the trustee will be the one that actually hold the money and try to safeguard the unit holders, the investors' interests, okay? So the three party here, okay? So in return, for the unit holders, if you are investor, what will you get? You will get capital appreciation plus the income distribution that you get from the funds, which means the total return. You will get all the returns that the fund generated, okay? Because in the market, most of the funds, when they are distributing income, right? When we are talking about income distribution, I would say 99% of the fund, they actually opt for reinvestment one. So technically, you don't get the cash flow one. Even though they declare dividend, they declare income distribution, all right? But this income distribution will actually be reinvested into the fund. So technically, you don't get anything from income distribution one. You only get extra units, just like giving you a bonus issue. It's actually the same concept, okay? So you need to look at your return on the overall value of your investment, which is coming from the capital appreciation of the NAV, all right? Okay, so what will the trustee get? Trustee, they will actually get their own trustee fee. Things are straightforward, okay? Fund managers, they will get management fee, all right? Okay, so the next one, there will be, okay, if we talk about unit trust, right, there will be a lot of different kind of unit trust, because be it if we are talking about equity investing, things are also very it could be very dynamic. How to say dynamic is that, for example, if you want to be a shareholder for a listed company, you can actually choose from company from the universe of Malaysia, Asia Pac. If you look at China, you can look at China, Hong Kong, Taiwan. There's a lot of market that you can actually set your sight on it, okay? But okay, this could be one of the method or the approach for us to actually differentiate where are the investment opportunity coming from. We can actually do it via a geographical location. Then the next one, it could be from investment strategy, okay? Because if we talk about listed company, it would be the listed equities, okay? But some of the funds, they can actually help you to invest into pre-IPO funds. They can actually help you to invest into special situation fund. What kind of special situation that we are talking about now? Okay, it could be restructuring companies, okay? So some of the companies, they may have some problems on their cash flow. So they are going into restructuring, and fund managers think that this company actually have a lot of value to be extract out once after the restructuring plan can actually go through. So they also have this kind of investment strategy for a special situation fund. And then some of the fund, they will be focusing on getting income, okay? So they will actually restrict themselves investing into stock that have a dividend policy, mainly what we call dividend stocks, all right? Then some of the funds, they will actually adopt the growth investment strategy. I would say most of the fund in the market that are performing better, okay, is because they are growth strategy fund. Because definitely, if you want to get a better return, you must invest into a growth fund. But of course, it will be attached and associated with higher volatility and higher risk, okay? So as investors, we will need to evaluate our own risk profile, I would say. Okay, then the third one, it would be on asset classes. It could be on equities, okay? So you invest into these funds, they help you to invest into a China growth fund, Okay, so if investing, for example, you can be investing into Greater China, which is China Technology Fund. So this one is an equity growth fund that is based in China. All right. Then the next asset class we could be talking about bonds, fixed income. Okay, so it could be on some fixed income bond from Malaysia, or you can invest into some fixed income bond from China also can. All right. So the third asset classes, it could be commodity fund, it could be a gold fund, or it could be some kind of precious metal fund that we can look at. All right, or some alternative investments. Alternative investment is other investment that is not classified in the normal or the classic investment classes like equity, bonds, or commodity. It could be watches, property, all this also it could be a alternative investment category. Okay, and one audience actually asked me to explain a bit more on the pre-IPO and special situation. Okay, so I elaborate a bit further on the special situation. Just now I did share about the restructuring. Okay, so we need to understand. Okay, so we need to understand for a company, be it is a listed company. Okay, before a company can actually go listed, most probably it need to be a startup. It need to be a new SME. Then it start growing for a few years. Then it start to apply for IPO. Then it go for IPO. So when we talk about pre-IPO, right, it's actually the company that actually stay at the stage before doing IPO. They could be a few years away from IPO, whereby the earnings are on their way. Okay, but they still haven't hit the threshold of being able to be listed lah. Okay, so these are the category that's what we call pre-IPO. But of course, when we talk about pre-IPO funds, right, it will definitely be associated with higher risk. Because why? Because they are all private companies. Before you are listed, before you are being publicly listed, you are a private company. That's what we call pre-IPO lah, before IPO. Okay, so definitely when there's lesser transparency, there's lesser news flow about the company, and it's quite tough for you to get the financial statement on the company, or you don't even have a chance to attend the briefing or the AGM of the company. So in terms of the news flow, and you can't really gather information about these companies. So of course, when we talk about pre-IPO or private company investment, the risk will be significant higher than listed equities. All right. Okay, so let's move on to the next slide. So just now I tried to break down the types of unit trust funds by asset classes, investment strategy, geographical location. Okay, now I will try to break them down into low risk, moderate risk, and high risk funds. Okay, so basically when we are referring to low risk funds, right, we are talking about money market funds, fixed income fund. Fixed income fund are the bond fund that I mentioned just now, whereby it could be corporate bonds that issue from companies, private companies or public companies, or it could be government bonds that issue from various government, like Malaysia. Our government bond, it could be Malaysian government securities, what we call MGS lah. Okay, if we are talking about Sharia compliance bond, it would be MGII, Malaysia government's investment. Yeah, all right, MGII. Okay, so this would be the fixed income bond fund. It will definitely be a low risk fund. Okay, but of course, there are some of the fixed income or the bond fund, it could be high risk also. If you have a bigger appetite, if you can take higher risk, okay, you can actually look at high yield funds also. Some of the funds, they actually invest into those smaller companies whereby they issue bonds. Okay, so these kind of smaller companies whereby they are financially unstable, okay, when they issue bonds, they will definitely need to compensate investors with higher return. For example, the return for a huge company like Tenaga, it could be only about 4%. Like our government bond, 3 to 4%. Okay, so very low return. So for this kind of investors, when you invest into this kind of bonds or bond fund, it will be what we call low risk, okay? But if you are investing into a new startup, okay, a new startup that is not making money, then it could be a high yield bond fund already. So this, it will still fall into a high risk fund also. So we need to understand about what kind of asset classes or what kind of investment strategy that the fund manager, they want to have it as the mandate, as the objective, the mandate of the fund they are whereby they are authorized to actually invest into. Okay. So a question to the floor, I would say, how many of you actually invest into unit trust before? Okay. If you did invest into unit trust before, give me a 1. All right. Another questions to the floor. All right. Okay. Another question now. Okay. Whereby how many of you here that answer 1 just now, right? You guys actually have a good experience investing into unit trust. Okay. If you have a good experience, you can type 2 for me. Thank you. If you don't have a good experience, you can give me 0, I would say. Okay. Okay, things are quite balanced. I see 3-2 and 3-0 at this moment. Okay, but there could be a lot of reasons why you are not getting a good experience from unit trust investment. Okay, but yeah, so let's drill further and see what I can share with you later on. All right. So another low risk investment fund that we could be looking at, it would be money market fund, whereby money market fund, they actually help you to invest into deposits. They help you invest into fixed deposit, short-term money market instruments. All right. So technically, if you put your money into money market fund, technically we don't call it investment, because you are just depositing your money into a fund whereby they help you to invest into fixed deposit. So here, I guess some of you may ask, if I can do the fixed deposit, if I can actually place a FD placement with the bank directly, why do I need somebody else to put my money into a FD for me? Okay, the context here is a little bit different. If you invest into FD, okay, if you want to withdraw your money before the maturity of your FD, at this juncture of the market, you will need to forfeit your interest. Okay, so for example, if you commit into a 1-year FD and you don't hold it and you don't place your money there for more at least a year, then you will need to forfeit your money if you want to withdraw it earlier. Okay, but when we talk about money market fund, we see it as a parking facility for investors. Why? Because now all the investors are actually pooling their money together. For example, if one of you want to put 100,000 into FD, okay? So if there's a lot of investors, when we are pooling money together, it could be 50 to 100 million. Then we put into the FD together, then the fund managers, they can actually spread it into a few I would say multiples of FD with different tenor. So in that case, when they are doing it in the money market fund, they can actually give you a commitment whereby you will not lose out any single day of your interest. So which means if you put your money into the money market fund for a week or for a month, you will still be entitled for that 1 week or for that 1 month kind of return. Okay, so this is definitely the thing. So structurally, it's different to actually benefit the investors so that they can get the interest on a daily basis. All right. Then when we talk about moderate risk, we are talking about a balanced mixed asset fund, whereby the funds actually have the mandate to actually invest into equities and fixed income. Okay. The next one, when we are talking about high risk funds, right? Then it will need to depend on what kind of strategy that the funds are actually investing. Okay, so if they are investing into a high risk thematic fund, for example, ESG renewable energy funds, then it could be high risk at this point of context, whereby the renewable energy company, most of them, they are still not making money. They don't have a very stable income stream, okay, and or the cash flow that we are talking about. So in that sense, this company, we are looking at the future. We are foreseeing that they will have a fantastic growth, and some point in the future, they can actually convert all their potential into solid cash flow that we can see that the company can enjoy. Okay, so if you're investing into this kind of thematic fund, the risk will definitely be high. All right. So it depends on what kind of strategy or what kind of location, geographical location that the fund is actually invested into. All right. So how does the unit trust can actually help us as retail investors who is actually suitable to invest into unit trust? Okay, those who don't have time to analyze about the market, to look at the news flow, and those who don't have the right technical knowledge. Okay, because if you want to equip yourself with the right mindset and the technical knowledge, definitely you need to spend months or years. And I would say not everyone are actually meant to be a good active investors, because if we look at our whole studying journey, be it primary, secondary or tertiary studies, right, there will be there will definitely be some of your teammates or some classmates they are studying very hard, but most of the time they are still not getting the flying colors that they want. Okay, they are not getting the good result that they actually wanted. So we have to admit that not everyone are a good material to be a good investors. All right. So the third kind of investors that don't have market sense is actually very suitable to invest into unit trust, because I would say the key, most of the time, right, when investor talk to me, or when they would like to raise some market concern, market questions to me, they will say, hey, how come, Anson, how come recently I have been seeing recession headlines everywhere, be it from the Oriental media, okay, or coming from the Western media also, I'm seeing the same thing. Okay, so but how come recently US market has been rallying? So I would say investors that don't have a market sense, they don't understand that market is actually driven by expectation. They don't understand that earnings is always behind the share price. You need to understand that market is actually works on expectation. When you can expect the earnings to be better, the outlook of the business to turn around or to become better, share price will move before the earnings can actually come in. So this kind of market sense, right, is one of the key criteria that investor should have. Okay, and Nuru actually asked whether market moves 6 to 8 months ahead, which means the share price actually moves 6 to 8 months ahead of earnings. I would say it depends. It depends on the industry. Different industry, it could have a different period or interval. Okay, and it also depends on the market sentiment or the context at that moment. For example, you will need to know, okay, if we talk about the glove sectors, because I would say during the COVID, most of the investors, they invest their money into glove, but they don't get the sense how come when the earnings are not falling, but the share price is already fall. So I would say, whether if you want to know that the market or the share price move how many months ahead of the earnings, right, you need to look at uncertainty, whether you can see through how many months of certainty at this point of time. For example, if certain industry you can really foresee for the next 5 years, things will be very stable, and the regulatory context also very favorable, everything also will be very favorable for the industry, then the market will see when the uncertainty is low, right, then the transparency is higher. Then the market will tend to price in more in a longer tenor, okay, in a longer term. So we will need to understand it is depending on the market, it's depending on the industry. Different industry could have a different time interval one. All right. So the next one, how does unit trust can actually help us? The second benefit, it would be diversification. Okay, because as a Malaysian investor, I would say most of my retail clients are retail investors clients are, they are actually investing all their money into the Malaysian equity markets. If they want something more stable, then they will look at the banking sector or they will look at the dividend stocks. But if they will want something more aggressive, then they will look at the technology stock, for example. Okay, so but I would say ultimately you are still investing into the same pool, the Malaysia market. So it will still be affected by Malaysia political context, and or it will still be affected by the Malaysia retail spending pattern. Okay, so they are still correlated in to certain factors anyhow. Okay, so as investors, we actually need to make sure our diversification can actually do it across border. Okay, for example, at this moment, if you believe that the valuation at the China side is at somewhere near the historical low, then you can actually put your money into the China market. And of course, looking at the US valuation at this moment, it could be balanced or fairly priced, but you don't want to miss out on the US rally at this moment. Then what you can do, you can actually put a small location into the US market. Okay, then if you feel that recession are coming and things are not definitely so positive moving forward, and you want to hedge your position, okay, what can you do? You can actually put some of your money into fixed income bond fund. Okay, like some of the bond fund which they help you to invest into government securities, whereby because government bond, they are super safe in the nature that technically in the financial world, we will call government bond as risk-free asset. So technically, they don't have any risk. Technically, technically, because if the government were to go into bankruptcy, then things will actually be very bad for the whole economy or the whole nation. Okay, so you can actually diversify your asset into fixed income bond fund as well. So if the market were to crash or if the market were to go into recession, right, then your position in the bond can actually act as a stabilizer, or it can actually help you to hedge against the market downside. Okay, because when market is not doing well, recession is hitting the market, then the central bank will tend to actually cut the rate. When market cut the rate, when central bank cut the rate, when the OPR actually go down, right, bond price will actually spike. When we talk about government bond, it will spike more. Why? Because as what I mentioned, government bond is a risk-free asset. So in the financial world, we actually see it as a safe haven. Okay, so it's actually a safe haven for the money, for the fund flow to actually move to the fixed income segment. All right. So make sure that you will actually need to diversify your portfolio across different asset classes, or it also give you a better option to invest into different nations. All right. So the next one, it would be the professional financial management from advisors or for the fund managers that has been investing their time and to look after your money and your investment. Okay, but because you need to understand that you are not a financial professional. If you don't have the time and you don't have the knowledge, you don't have the right mindset, how are you going to outperform the market benchmark? Technically, I would say there's no way. So the easiest way is that you rely on financial professional. Then in return, you pay them some fee. So as an investor, what you need to do is evaluate their performance. Later, we will talk about how do we actually evaluate their performance. All right. Okay, so unit trust can actually help us to actually invest into a bigger pool of securities with lesser money, significantly lesser money. Because if we look at the most of the retail unit trust fund that is available in the market, most of them, they will have a minimum investment amount threshold of only 1,000 ringgit. So for example, if you want to invest into a global technology funds, right? For example, like if we talk about Apple share price, it's impossible with 100 100 ringgit you cannot do that lah. Okay, with 1,000 you can still do that. But if you want to buy one unit of the Apple share, perhaps it will takes you if I factor into the currency of 4.6 at this moment, 1,000, perhaps you can buy about 1 unit of Apple share lah. Okay, but you can't really diversify into different securities. Okay, so investing into a global technology fund, you can actually be the shareholder of Amazon, Tesla, Apple, Google, Microsoft, and Facebook. There will be more companies in the list, okay? Because technically, typical retail unit trust fund, they actually invest your investment into at least 40 to 100 securities or 40 to 100 company lah. So in that sense, you're investing into a pool or a whole universe of technology, good technology stocks. They will help you to do the stock picking, and they will decide which one is actually having a cheaper valuation. Then they will actually decide to overweight on that particular stocks. Okay, so what we need to do is, like what I say just now, evaluate their performance. But unit trust can actually give you a lower threshold to start investing. All right. The next one, it would be the huge liquidity that the investors can actually enjoy. Because when we talk about unit trust, it is a pool of investment that coming from various investors. There's a lot of us that we are pulling money into these unit trust funds. Okay, so the fund manager can actually utilize the fund inside the pool and invest it into many companies. Okay, so it also provides us the liquidity whereby as a normal retail investors, even though you're only investing 1,000 ringgit into this fund, if you want to withdraw it, they will actually give you, you will actually just need to give them a 5 working days to run and fulfill the whole settlement process or the flow. You can actually get back your money. Technically, if we are talking about local funds, Malaysia funds, a 3 business day will do. But most of the case when we are talking about Asian or global funds, right, it could be 5 to 8 days. All right. So we are also enjoying a good liquidity. All right. The next benefit, it would be there's a lot of transparency on the information about what they're investing and what kind of mandate that they actually have it in for this fund, and they will actually put all the information in the fund fact sheet for the investors to look at it. Then annually, semi-annually, they will have their report to let them know they spend how much on their expenses or like the management fee, then how much is actually they actually paid it to the trustee, then how much are actually the performance or the return, or whether they're actually outperforming the market. Okay. One questions to the floor. How many percent of the sales charge, right? Because now we are talking about charges and the fee. How many percent of sales charge are actually you guys are paying to your advisor or to your relationship manager or to your unit trust agent? Can you share on the in the chat box to me? All right. How many percent? Because in the market, the maximum sales charge that they can charge is 5.5%, I would say. Okay, don't be shy. Okay, yeah, there's 3 comments coming from, yeah, there's a few lah. Okay, 3, 5, 6, 5%. So, wow, actually most of you are actually paying the fee on the upper end, I would say, upper band, I would say, because if for example, like my own practice, we actually charge only 1.5% sales charge. So but ultimately you will need to understand what kind of strategy your advisor or your unit trust agent are actually adopting for you, how they are actually playing around with your portfolio, how they help you to switch your position when things are changing. All right, so we will share more about all these things later. Okay, so when we talk about fee, there will be direct fee or an indirect fee. Okay, direct fee, things are very straightforward. When you invest your money, you directly pay another sales charge. You pay the sales charge directly to your agent. Okay, so for example, if you invest 10,000 ringgit, if they charge you 500 ringgit, more or less it will be about 400 and 500 ringgit that will become their commission. So the leftover 9,500, it will be invested in your portfolio. It's not the 10,000 that you actually invested. All right, so this is the sales charge. Then the next one, we some of the funds are, especially in bond funds, you can actually see redemption fee. Indirect fee would be management fee, performance fee, and trustee fee. Okay, so let's move on to the first one, sales charge. This one is actually the upfront fee that the sales distribution channel or agent, they actually charge to investors. Okay, typically it's about 2 to 5.5%. Okay, typically it's about 2 to 5.5%. All right. So the next one, it would be redemption fee. The exit fee when you wish to redeem your investment. So because some of the bond fund, why they actually need to impose this kind of exit fee to investor? Because if your holding period is too short, because some of the bond fund in the market, okay, if your holding period is less than 1 year, for them it's too short already, then they will need to impose the exit fee. Typically it would be 1% to you, okay, to penalize you from exiting from the bond fund too early. But I would say majority of the bond fund also, they don't have redemption fee. It's only minority of the funds. All right. The next one, it would be management fee. Management fee, it would be the they will actually need to expense it to cover the ongoing cost of the management team, the fund managers. All right. So this kind of expenses, they actually spend it on the portfolio management team, the research, or the administration team, or all the others operational costs. Typically, management fee will range from 0.8 to 2%. It depends on what kind of fund that you are investing. If we are talking about a low risk fund, typically it would be 0.5 to 0.8. All right, okay. But if we are talking about aggressive fund, growth fund, whereby the stock picking skill set from the fund manager will make a huge difference, then typically they will charge about 1.8 to 2%. They will charge more in terms of the management fee. All right. But the key for the investor, we only want to look at the return, whether you are actually performing good for me. Okay, so if you can generate good return for me, we don't really mind to pay you the fee, I would say. Okay, so the fourth one, it would be the trustee fee. Okay, because we will need the trustee to segregate our asset, to act as the custodian of the asset. So in this context, we will need to also pay them the trustee fee to actually safeguard our asset. Okay, normally trustee fee is only it will be technically below 0.5. All right. Okay, the next one, it would be performance fee. I would say commonly performance fee is not something common now. Okay, performance fee is not something common. It would only be charged on certain funds, for example, pre-IPO funds or special situation funds, whereby these funds, they are adopting a super high risk or super aggressive approach. So whereby fund managers, they will need to pay extra attention to their stock picking and to the investment. So in that sense, they would like to align their interests with the investors. Okay, so they will charge you a performance fee, be it 5 to 15%. In the market, 20% also got lah, okay? In the market, 20% also got. So it depends on what kind of mandate or what kind of strategy they actually want to set it for the funds lah. All right. Okay, so let's look at how we actually evaluate the fund performance and the returns. Okay, so normally when we look at the cumulative returns, for example, this fund incepted or launched in year 2020. Okay, so it have a timeline of about a period about 3 years. Okay, so we will just look at cumulative from day one until now. What kind of return are we actually looking at? So this will be another type of absolute return. So which means cumulatively it could generate, like for example, 30% throughout the past 3 years. So this 30% is what we call absolute return. All right, but if we are evaluating the performance by comparing it to the benchmark, then we will call it alpha. Okay, so this is the key thing on how we actually look at the fund and see whether things are actually performing well or not, whether this team of fund manager, they are doing their job well or not. For example, if like what I say, S&P for the past 10 years, they're actually giving an average return of 9%. Okay, so if we are investing into a US big cap fund, okay, a US big capitalization funds, okay, so you will definitely need to outperform the average of 9%. If you couldn't invest in if you couldn't get an outperformance of more than 9%, right, technically you are not adding value to this fund. Then why not I just invest into the ETF? Why I still need active managers to do the stock picking for me? Okay, so I would like to emphasize to all of the audience here today is that ETF have their own value also, but active fund still have their own value added feature to actually add on that kind of value to provide to investors. So as investors, we must learn and know how to evaluate their performance rather than if you look at a good market context. Okay, for example, when we're talking about good market in year 2020, okay, whereby after the first 3 months of the COVID market actually rallied significantly, okay. If we talk about the US Nasdaq, I would say performance is actually more than 30% in 6 months time. Okay, more than 30% in 6 months time. So if you are looking at the ETF, if you can only get 20%, but the active fund can actually give you a 30% return, then in the sense that they're actually providing you a 10% alpha, then why not you just give a 2% management fee to the fund manager? So in the sense, we need to evaluate whether things are worth it or not. All right, by looking at alpha, this will be more reflective and it makes more sense. Okay. Then the third one, it will be comparing against the peers. Okay, then the third approach, it will be we compare the return on with all the big cap US big cap funds. If we, for example, if you look at all the fund houses like Maybank or Principal or Public Mutual or MBank, they will definitely have their own US focused big cap funds. So you just pick on all these funds and look at their returns, whether which one are actually performing better. But ultimately, I would say out of 3 types of evaluation method, the best one, you will be looking at whether they're actually giving a good alpha. Okay, this one is okay. So the next approach for us to actually look at performance and return, it would be looking at the returns. Okay, cumulative return, things are very straightforward. From day one until today, what are the cumulative returns? Okay, then the next one, it would be annualized return. Okay, for example, in this example, you can actually see, okay, if in 3 years time this fund actually generated 20%, so averagely annualized, if we try to average it up, it would be about 6 point something per annum. Okay, so this would be the annualized return. Then the next one, you will be looking at calendar year return from 1st of January until 31st of December. What kind of return we are actually getting from that particular calendar year. Okay. So right now, I will bring you guys to navigate a little bit on the Bursa marketplace, whereby Bursa actually launched their funds platform, whereby it's acting as an info hub to help retail investors to get more information about unit trust funds. Okay. So if you go to the Bursa marketplace and you look at their fund platform, you can actually go and look at their tools and find the filters, and you can actually classify what kind of criteria, what kind of factors that you want for your own preference. For example, if you want to look at funds from the China side, you can select the geographical location at China, then they will filter out all the China funds for you. So if you want a Sharia compliance fund, you can pick it also. Okay. And just for your information, we can also use EPF to invest into unit trust fund. Okay, because as we all know, EPF gives us an average 5 to 6% return. Okay, it depends on the market as well. 5 to 6% return on the conventional side. Okay, the return from the EPF. So if looking at some of the good technology funds, on average annualized, for example, if we look at some of the good technology funds, okay, in the past 10 years, they can easily give you more than 10% every year. So then why not you can actually consider to invest your money into the EPF approved fund, whereby you can enhance your return, enhance your capital by a few more percentage point every year. Okay. So personally, I have been fully utilized the threshold and the capping for this EPF approved fund also. All right. Then after that, once you filter out, you can actually select some of the funds that you want to actually click into it. Okay. Then you can actually see what kind of category, then what kind of asset allocation they're actually having, then their investment objective, their mandate, which is what we call they are actually have the authorization to invest into what kind of location and what kind of strategy they're actually having. Okay. So all the information you can actually look from the page, the fund page. All right. Then after that, you can also look at all the performance. Okay. Cumulative, annualized, calendar year returns. Okay. Okay. So some of the investment myth about unit trust. Okay. It could be, I would say the key one, it would be two. All right. The high charges that charged from the advisor or the agent. Then the second one, it would be the poor performance. Okay. For the high charges, this area, okay, I would say investors, we will need to know how to evaluate the performance of your advisor. Okay. If they are helping you to invest into good equity funds, whereby if we are talking about equity funds, right, definitely you cannot just invest all your money into a single particular country or invest into a single particular industry. What you need to do is you need to construct a portfolio with the mixture of bonds, equity, then equity allocation, you segregate it into US exposure, China exposure, local Malaysia small cap exposure. You will need to have all this kind of rebalancing within the asset classes to help you to diversify your portfolio. Okay. So when we talk about charges, you will need to, okay, of course, when you are asking somebody to do something for you, you definitely need to pay them. So you need to do your job as well as an investor, evaluate their performance, see whether they are doing the right thing for you or not. Okay. Then how to evaluate their performance, like what I mentioned just now. Compare the portfolio performance to the benchmark that both of you mutually agree that you guys set together. Okay, you evaluate your performance on that set. On that sense, see whether they're actually adding value, adding alpha to your portfolio or not. Okay, this could be one of the most effective way. All right. And the second problem, it would be most of the investors, they always say, unit trust, is a scam lah. Unit trust is a scam lah. They are not generating good returns for investors lah. Technically, I would say this is definitely an investment myth for retail investor. Why? Because there are a lot of good funds in the market. For example, I just give you one example like the M China A share. If you look at the calendar year's return, for example, okay, 2018 because of trade war is down 23%. But if you compare to the benchmark, it's still outperforming the market. Benchmark down 32%, it's only down 23%. And I would say the key problem with investors is that once they see their portfolio is in red, they will straight away complain, you are not doing your job. You are not doing a good job. But actually, if the market is actually dropping 30% and I managed to help you to reduce the impact, the damage to 20%, you should actually thank me. Okay? So you should actually appreciate the value added services from your advisor instead of if you just see negative 20%, then you start to complain. This is not the right way also. Okay. Then after 2018, 2019 is a good year. 2020 is also a good year because post-COVID. Okay. Then in the second half of 2021, things start to come down again. And in the year 2020, things are looking very bad. Okay. So I would say when we invest into market, we will definitely need to look at the valuation of the market. For example, when this market, the valuation is cheap, you can actually overweight more of your investment into this market to tap on the cheap valuation. Okay, once things start to reflect and once things start to rally and the valuation is getting more fairly priced or is getting overvalued, then you need to actually trim your position down, okay, to somewhere that is undervalued. This is the right way that advisor or agents to actually do it, in the sense to rebalance the portfolio for the investors. To always, you shouldn't just look at what kind of potential return that you can generate. You should actually look at how to manage the risk by reduce the volatility, reduce the risk of the portfolio. How do we actually reduce the risk? Buy into something that have a lower valuation. Lower valuation, definitely it means that the pricing is cheap. But when we talk about stock investment, things may not work that way also. Why? Because it may be due to some of the reason or the causes. If it have some root cause that why this company is not doing well. Okay, so in that sense, if we cannot see through the root cause and we think this company will definitely come back. If we look at the historical performance and we look at the historical valuation or historical PE, this company can definitely come back. And end up, you may make a mistake and this company can never come back. Okay, but that one we are talking about single stock investment. But if you are talking about doing a portfolio with various regional investment, various asset classes, you will never go wrong. Okay, you will never go wrong because you are actually balancing your portfolio by looking at a pool of investment, I would say. All right. So there's one question coming from Nurul asking, what is the benchmark used as the comparison done by M China? They're actually using the MSCI China A Onshore Total Return Index. You can try to Google, you can get the performance and the underlying of the index also. Yeah. Okay. So let's move on to the Q&A session. Yeah, you can just write your question in complete sentence. So yeah, yes. I will try my best to address. All right.
Thank you so much, Anson, for doing this wonderful session on unit trust. So now we know about unit trust and how do we evaluate unit trust performance. If you have any questions to ask our speaker today, you may write them at the Q&A box. Okay, don't write them in the chat box. Yeah, write them in the Q&A box. So the first question is by Lima. I think Anson just now you mentioned that bond fund charge redemption fee, right? How about other funds? Do they charge?
Okay, commonly bond fund charge redemption fee, but I would say in terms of ratio, like it's only about 5 to 10% of the bond fund in the market, they actually impose a redemption fee. But if you want me to give some example in other fund, I would say some of the pre-IPO funds, they actually also have redemption fee. Because for example, one of the cases is that some of the pre-IPO fund, for example, if they were to invest into one company that is pending to go for listing in 3 years' time. Okay, so they actually if you invest into this pre-IPO fund, they take your money, they help you to invest into this kind of company, they will need to lock their investment for a few years, because when they are investing into this pre-IPO fund, they are actually investing into private companies. Private companies, they don't enjoy that kind of liquidity whereby you can easily go in and go out. So in that sense, if they are forced to actually liquidate their position at that point of time whereby you want to exit your investment, right, they will actually lose out in terms of the valuation, and it's a bit unfair to the rest of the investor that would opt to actually stay within that fund. So in that sense, they will actually need to impose a redemption fee to penalize on those who want to exit earlier. Yeah.
So the redemption fee is only charged if they leave earlier than the lock-in period, am I right?
Yes, yes. All these things will be communicated before you actually invest into it. Your agent or your advisor should do that. Yeah.
Okay, so in other words, those that are very short-term, like money market funds, they should not charge.
Yeah.
Only funds that require a bit longer tenure may charge the redemption fee if you redeem it way earlier than the lock-in period.
Yeah, because the key concern is because the fund manager, they can't really liquidate your asset at that point of time. They will have liquidity issues. So that's why they will impose this kind of fee to ensure not so many investors will exit halfway. Yeah.
All right. Now, just now you show M China A Shares Fund. And I think in the first 3 years, we see that it beats the benchmark. Then after that, there are 2 years, it did not meet the benchmark. So what is your opinion on this? So this is by Steven.
Okay, so on this context, right, normally we would need to look at their holdings. Okay, we will need to look at their holdings and know on a short-term basis what they are focusing more on. Because for example, this M China A Share, they have the mandate to actually invest into China onshore equities. Okay, so it could be at this point of time, they are overweighting on technology, or they are overweight on traditional big caps. So technically you will need to get all this information from your advisors or agent. Then only you can make the decision on whether you want to move up from whether it's fair or not to evaluate them all the while according to the benchmark. Yeah.
All right. So Albert would like to ask, is there any unit trust that can guarantee an earnings above all the fees that they charge? Like they charge 2% fee. Are there any unit trust that can guarantee you that the performance will be better or higher than the fees that they charge?
Technically, in our life, there's nothing is guaranteed, I would say, especially when we are talking about investment. So as investors, you need to understand the risk and the reward and make sure that you're actually making a informed decision. I would say this is the key. Yeah.
All right. And would like to ask, she said that my exposure to unit trust is via my life insurance policy, which I have no choice to exclude. I learned lately that this unit trust can have the possibility to not be able to support the policy 10 years before maturity, and we have to top up our policy subscription because of that. So can the long-term unit trust go down to zero?
Okay, I just add on to the previous question just now, whether he said things can be so-called guarantee, okay, whereby I would say ultimately what you need to do is make an informed decision and find the good funds that exist in the market for quite some time, and they have a good mandate and a good investment fund manager team now, okay. And I would say there's a lot of good active funds in the market whereby when we are talking about alphas, right, most of it are actually coming from the Asia Pacific region, whereby if you are just investing into China or Singapore by ETF, right, most probably you are getting very bad returns, right? But if you are investing via active funds, right, it's very likely that they can add a good alpha to your funds. Unlike the Western world, whereby because in the US or the Western world, in the developed nations, right, the transparency and the access to information is very efficient already. So it's pretty tough for active fund manager to really outperform the benchmark. Things could be very different in the context. Okay, so come back to this the question about the insurance life policy. So I assume that you are talking about investment links insurance. It should be medical cards or life insurance also got this kind of investment link component. Okay, so the first thing that you said, which you have no choice to exclude, is technically wrong. Okay, because as a financial advisor, I'm not only I can market unit trusts, I can do stock advice. We can also do wealth protection, whereby I also market insurance products. Okay, and estate planning also we do will and trust. Okay, so I can give you, actually you have a choice to exclude. You can actually opt to go for traditional policy, whereby you only fund that investment cost or that insurance cost for your policy, not funding on both sides, investment and the insurance. Because in the investment link policy, right, the whole concept is that they want to make sure you save more in the early stage, and in the later stage when the insurance cost is higher, you have the money from your investment pool to actually fund for the higher insurance cost. So if you are somebody that you know how to plan your financially well, and you know how to do your investment by yourself, or you have a good advisor advising you on how to do your investment, actually you can exclude yourself from doing or protecting yourself with investment link policy. Okay, so the next thing is whether there's a possibility that it cannot support your policy for 10 years before the maturity. There will always be a possibility. You will need to look at the performance of the unit trust. I would say most of the time, right, for insurance policy, you will need to make sure that you are investing into something more aggressive. For example, like the US developed countries funds or the China funds. Why? Because over the long term, because when we talk about insurance policy, things are about 20, 30 years. So over a long time, they are likely to give you a better cumulative returns or annualized return. This is the case. So make sure that you put into something more aggressive. If you put into bond funds only, I would say we are talking about average return of about 4 to 5% for the annualized return. So there is a high possibility that it cannot support your policy in the later stage, because 4 to 5%, it still depends on the market, because ultimately when we talk about investment, but the return in terms of the context-wise, bond funds in the investment link policy and the equity funds in the investment link policy are the returns we are talking about different things already. Yeah. All right.
Thank you so much, Anson.
Yeah.
The next question is by Harif Yusuf. He's asking for your opinion. For an equity fund, how long should we invest until we can consider to cut loss?
Okay, so for these questions, right? It's very different compared to, okay, if you are investing yourself, active investment, then we should actually have a good strategy to know whether you want to cut loss or you want to take profit at when. All right, but when we are talking about unit trust fund, you need to make sure you look at the whole portfolio, whether you are actually balancing on the exposure and the risk well. This is the key thing, rather than you focus so much on the whether you have to cut loss or not, because you need to understand one thing. When you're investing into an equity fund, you're investing into the whole basket of securities that is inside the same exposure. So unless you change your view on that particular basket of investment. Otherwise, most of the time, we will not cut loss, or we may actually rebalance our portfolio to top up on this kind of equity funds. For example, for the past 2.5 years, China funds has been performing very badly. And if you are investing into some of the China's funds, I would say China A share, the magnitude of drawdown is about 40%. Okay. And for example, if you are investing into the ARK funds, because some of the unit trust fund in Malaysia, they also feed their investment into the ARK ETF, okay, whereby some of the ARK ETF also the magnitude of the downside and the drawdown is also about 80-90%, okay, from the peak. So you will actually need to understand on the context of the investment strategy, rather than you say if you how many percent, or whether I need to use technical chart to actually see whether I need to cut loss or not. This is not the case. I would say when we talk about unit trust fund, things are more fundamental. Don't use technical in this sense. Okay, things are more fundamental. You need to look at the whole market, whether valuation is cheap. If you think that the valuation is cheap, then actually it's more wise for you to buy more. Unit trust fund, things are more fundamental. Yeah.
Thank you so much, Anson. So the next question is, do money market funds generally have better returns than term deposits? And how about the risk comparison with term deposit?
Okay. Generally, they are the same. For term deposit, right? Okay. Typically, I would say, money market funds, they will generate you a return that is very close to the board rate that we see in our FD for 1 year. For example, if this kind of context, we are looking at a board rate of about 3.3, then your money market fund, if you enter today and you hold it for 1 year, likely you are getting close to the board rate of 3.3%. Yeah, this is the return is more or less there. But if you are talking about sometimes when you're investing into term deposit or fixed deposit, that you are getting a promotional rate that there is, for example, that we can get like 4%, right? Then it's impossible. But the downside of FD is that you need to lock down your capital for quite some time. No? Money market fund, you can park it for a few weeks, so it's okay.
All right, thank you so much, Anson. The next question is, can you make a comparison between unit trusts and closed-ended funds? We know that unit trusts are open-ended. So how are they different in terms of their performance?
Okay. Actually, the difference between unit trust fund and the closed-ended fund, right? Actually, unit trusts also have closed-ended fund one. For example, like the pre-IPO fund that I mentioned just now, most of them, they are actually closed-ended fund, because they will have actually a few months of time for them to gather interest for investor. You put in all your money, then we take all your money to invest into all these private company, then we stay with them for a few years. If you want to exit halfway, I will charge you an exit fee, redemption fee. But if you don't, then nobody can come in and nobody can go out from that fund itself. So actually, unit trust fund, they also have closed-ended fund one. So closed-ended or open-ended is actually just the structural way how they want to structure the fund, whereby open-ended, which means you can enter and exit anytime. This is only is something structurally different. Yeah.
All right. The next question is by David. As the US will be raising the interest rate this year, probably 2 more times, is it the right time to invest in bond funds?
Okay. Like what we mentioned, same goes to equity investments also. Market always work on expectation. So yeah, so for example, if the expectation at this juncture, market are actually foreseeing the US Federal Reserve to actually raising the interest rate for 2 more times at this year. Actually, if you look at the pricing of the bonds overall at the US currency denominated bonds, okay, actually the bond prices have already reflected on the expectation, whereby the bond price has already come down. Okay, so whether it's a right time or not, the key question is that you need to ask yourself whether you think 2 times is definitely the case, or they may change their thoughts again. And
could it possibly be they raise the rate 4 times or 5 times? So this is the key question that you need to ask yourself to evaluate the risk. If you think that 2 times is definitely the case and this is already the expectation at this moment, then it could be a good time to invest now already. Yeah.
All right. So let's do one last question by Nurul Anhar. Can you highlight the differences between unit trust and exchange traded funds?
Okay. So basically, right, unit trust and exchange traded fund, they are both actually funds. What we call funds is actually investors, they pool their money together, and fund manager, they take the money to invest for you. Okay, but when we talk about ETF, these are the really passive funds. And when we talk about unit trust, these are the funds that is active funds, whereby they will be fund manager actively trying to help you to find some better investment opportunity, and they will be actually trying to value add more returns, more alpha to help you to actually outperform from the standard benchmark. Whereby ETF, their role is actually just track the benchmark return. So if you invest your money into ETF, what you will be getting is actually the benchmark return, reduce some of the expenses that they still need to maintain some of the admin team and things like that. So, but the expenses will be very low because they don't need to do anything, but they just follow and track the index. But when we're talking about unit trust, they will need a good team of fund managers whereby to find some good investment opportunity for you guys. Yeah.
All right. So thank you so much, Anson, for sharing with us, grow your wealth, unit trust. So ladies and gentlemen, you just heard from the founder of Bull Bear Bursa, which is Mr. Anson Tan.